Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. It's our pleasure today to host colleagues from the World Bank, in particular, Ayhan Kos and Kirsten Stamm from the Global Economic Prospects Group. They are presenting today one of the thematic chapters from their latest Global Economic Prospects out a couple weeks ago. The whole document is available online, both at the bank and at PIAE.com. We are delighted to have Ayhan and Kirsten here to talk about the magic of investment accelerations. Before we get to substance, just sort of a note that it's been our pleasure increasingly in recent years to increasingly host a number of the flagship reports of the various major international institutions, again, on their thematic chapters. There are other places that host them for the updates of the outlook or for their latest data. But we want to give additional attention and constructive critical scrutiny to the places where the institution's analytic capacity is brought to bear on important themes. And so this is the first one we're doing in a while with Global Economic Prospects from the Bank, but we hope it is not the last, and we look forward to today's discussion. The theme, the magic of investment accelerations, is about fundamentally how investment powers economic growth, but also helps cut poverty and tackle climate change. The policy action to get these kinds of investment accelerations, however, is not entirely clear. And so the contribution that I think this report is making is to both specify how much is at stake if you can truly induce an investment boom that is sustained and in a constructive way, and some of the policy ideas for how to make that sustained. They have very interesting new research on how investment growth has jumped in these episodes for sometimes up to several years, and with lasting impacts on output growth and productivity growth. In a world where the US government talks about IPEF and investment deals with various developing countries, where China has held forth certain conditional prospects of large-scale investment, where India notably, along with a few other countries, Turkey before recent inflation troubles, have successfully managed to create at least the perception of such investment booms. This is an extremely timely topic. So let me introduce our speakers. Starting off will be Ayhan Kos, who is the Deputy Chief Economist of the World Bank and Director of the Prospects Group. He is a member of the Chief Economist team overseeing the bank's analytical work as well as policy advice. And most people know him as the face and the leader of the bank's work on the macroeconomic outlook, as well as some work on commodity markets. The Global Economic Prospects and also their Commodity Markets Outlook are their flagship reports. Again, I recommend to you the newest version. Prior to joining the bank, he had been in the research department and in the multilateral surveillance division of the IMF. Following him will be Kirsten Stamm, who is an economist in the Prospects Group at the World Bank. He is one of the co-authors of this analytical chapter. I call it a thematic chapter. They call it an analytical chapter, but it's the same point. This is not just an updating of forecasts, even as important as this is a cross-cutting look with new research. He has been focused on issues of investment and potential output growth. He previously worked on distributional, this is Kirsten, impact of private sector investments and job quality measures in the World Bank's Poverty and Equity Global Practice Group. We were able to turn in-house for an ideal commentator to lead off our discussion of the report, my colleague Arvind Subramanian. Arvind has been associated with the Institute for 2007, and we're very proud that starting last September, he rejoined us on a full-time basis. Arvind was previously, notably, chief economic advisor to the Modi government and the finance minister of India during 2014 to 2018, where he in turn had created a new flagship report out of the Economic Survey of India annual. He also was involved in the Uniform Nationwide Goods and Services Tax, a bankruptcy code, a digital and financial platform for connectivity, and universal basic income schemes, all of which contributed to the justified, if exaggerated, perception of India surging forward in recent years. Following his time in the Indian government, before returning to Peterson, he also served as a senior fellow at the Watson Institute at Brown, as a distinguished non-resident fellow at the Center for Global Development, and as a professor at Ashoka University, New Delhi, as well as at the Kennedy School. He continues to advise the Indian state of Tamil Nadu, and I believe there's an additional state that's signed up for his wisdom that's not in my notes. So with that, we hope to have a very substantive discussion. This is all on the record. After our 3 presentations, we will have some directed discussion amongst them and then open it up to the floor for additional comments and questions, preferably questions. Thank you for joining us today. Ayhan, over to you.
Thank you. Okay. Great. Good afternoon. It is great to be here at Peterson, and let me thank Adam for his invitation and his team actually putting together this wonderful event, and I'm very happy to see many friends here with us. And many thanks to Arvin. I cannot think of a better discussant for this piece. And I'm also happy that, Adam, we are presenting here at Peterson this piece. We don't write, pieces, the magic in its title every day. So this piece talks about the magic of investment booms. And I can't think of a better place than Peterson to talk about the magic of investment booms. There are some policy messages resonate with the colleagues here at Peterson, of course. Kirsten is going to continue after I talk a little bit. Let me also mention Shu Yu and Jakob Dehan also contributed to this chapter. So what is the motivation here? Adam already mentioned, but let me make the following statement. Investment is the single most important factor to solve many of economic problems. So you want to have higher growth rate, you want to address problems associated with climate change, you want to create jobs, you want to overcome deficiencies of education systems, health systems. What do you need to do? You need to invest. And that's exactly what we tell policy makers. Find ways to accelerate investment growth. Now, that's all good, but when you think about recent debates, it is very clear the global economy is facing a monumental investment challenge. What is that challenge? It will take a staggering amount of investment resources on the order of, depending on country you look at, between 1 to 8% of GDP to meet critical development goals and, of course, climate-related goals. And those goals we would like to meet by the end of this decade. That's what the global community set itself for. The price tag for these investments are largest for developing economies, where you have, of course, the biggest investment gaps. So now, the likelihood of increasing investment at the scale I mentioned, it will require trillions of dollars every year, might seem rather basically low if you just think about the type of investment growth we have seen recently. Here on the left panel, you see investment growth average over certain periods. in emerging market and developing economies. EMDEs stand for emerging developing economies. So as you can see, in the early 2000s, on average, these economies deliver growth actually higher than 10%. After that, after the global financial crisis, investment growth slowed. Now, on average, that number stands around 5%. And if you look at 2024-25 forecast, actually around 4%. So ultimately, investment has to be accelerated at home. So emerging developing economies need to find a way to ramp up investment by their own initiatives mostly. The good news is that investment can be accelerated with magical outcomes in terms of economic growth, in terms of productivity growth, in terms of poverty reduction, and in terms of these countries moving from one income category to another. If you're a middle income country, you would like to become high income, that goes through often having higher investment growth. So what do we do here? We focus on episodes of investment accelerations in emerging market developing economies over a long time period, where we see sustained investment growth over a reasonably long period of time. So our objective is to understand what happens during these episodes and what types of policies spark investment accelerations. So what is an investment acceleration? So the way we define it, these are periods you see at least 6% on average growth over at least 6 years. So you have sustained investment growth for at least 6 years. It is an acceleration in the sense that relative to the previous 6 years, on average, each episode sees at least 2 percentage point increase in investment growth. Okay, when you basically focus on those episodes, since 1950, there are close to 200 episodes in a sample of 104 countries, okay? 80% of these acceleration episodes took place 6 to 10 years. Okay, this is not 2-3 years you basically increase investment growth. We are talking about at least 6 years. A typical economy experienced two episodes, okay? 2 episodes over a 70-year period. Now, on the right, what you see here, share of countries that started an investment acceleration over different time periods. From 1960 up to now, in each decade, on average, we see 1/3 of countries starting an investment acceleration. 2000s were an exception. You saw around 50% of countries started an investment acceleration during 2000. Since the global financial crisis, that number went down to around 25%. So investment growth slowed, and the share of countries that basically experienced investment acceleration declined as well. Kirsten is going to talk about these magical outcomes we see during these episodes and what types of policies are associated with investment accelerations. Before I turn to Kirsten, let me make 2 points. First, we are economists. We pay attention to causality. This study does not make any claim about one-way causality from investment growth to these magical outcomes. We basically do an exercise that is like backward induction. People would like to increase investment growth. We say, let's focus on these episodes. We saw high investment growth. What happened during these episodes? And what policies triggered these episodes? But as you will see, the regularities we document and how often these episodes take place tell us something about the importance of outcomes as well as policies associated with investment accelerations. Now, the second point is that we do not look at the issue of efficiency of investment. It's a very important issue. You can invest a lot, but you can invest inefficiently. That's not something we discuss. And I think it should be discussed at the country level. And we are hoping that, now our country teams looking at this issue in different regions, countries, they are going to focus on the efficiency of investment. Also, there is this sectoral dimension of investment. We look at private-public investment, how these things evolve, but that's basically scratching the surface. We are not doing any serious analysis of sectoral investment accelerations. That's also very important. Now, in most cases, we just document some empirical results and leave it there. But in this study, there are case studies looking at investment accelerations. In 10 countries, we look at 13 episodes of investment accelerations and provide a narrative, what happened and why happened. Most of these case studies were written by people, actually, citizens of those countries. So assuming that they intimately know what happened. With that, let me turn to Kirsten.
Thank you, Ayhan. I'm going to focus on two questions today, very specific. What happens during investment accelerations, and what type of policies can spark these accelerations? Now, investment accelerations are not just periods of sustained investment growth. When we look closely at these episodes, what we found was that output and productivity growth increased, the structural transformation gained momentum, and poverty fell faster. On the left, you can see that investment growth basically triples from 3% per year in the 6 years before an acceleration to 10% per year during accelerations. Private and public investment growth increased in a similar rate during these accelerations. Output growth increased by 2 percentage points, from 4% per year before an acceleration to 6% per year during acceleration. And productivity growth more than doubled, from 0.8% per year before an acceleration to 1.7% per year during accelerations. And this higher output growth happened predominantly in the manufacturing and services sector. In the center panel, you can see that during accelerations, output growth in the manufacturing and services sector was much higher than before an acceleration, but in the agriculture sector, output growth was about the same. So these accelerations were periods during which the structural transformation in emerging market and developing economies gained momentum. And this has also implications for our progress on development goals. For example, on the right chart, I'm showing you the change in the poverty rate that accompanied high investment growth. During accelerations, the national poverty headcount fell by 1.2 percentage points per year compared to just 0.3% per year in the 6 years before an acceleration. All of these changes, by the way, all of these differences are statistically significant. And even though I'm comparing the 6 years before an acceleration today with what happens during acceleration, you can also compare the outcomes during accelerations to all other non-acceleration years. And you will find very similar results. Now, when you see these strong periods of high growth, the question that comes to your mind, of course, is what happens to key macroeconomic indicators during accelerations? And here the surprising answer is macroeconomic indicators stabilize and improve during these accelerations. The reason they do so is because what we find is accompanying these accelerations, countries implement comprehensive reform packages that stabilize fiscal, financial, and monetary conditions. And I'll talk more about policies in a second. But on the left, you can see inflation falls from about 8% per year before an acceleration to 6% per year during accelerations. Government debt as a share of GDP declines from 45% of GDP to 38% of GDP. And this is accompanied by much faster growth in trade and net FDI inflows. Export growth basically more than doubles from 3.7% per year to over 8% per year. And net FDI inflows increased by 1 percentage point of GDP during accelerations compared to before accelerations. Financial conditions, by the way, also improve. Credit growth almost doubles from 6% to 11%, and the real interest rate falls. So taken together, these accelerations have really been transformative periods in the economies where these occur. So that brings me to my second question. What can policymakers do to spark these accelerations? And to answer this question, we undertook 2 exercises. First, we looked at the 192 accelerations in our data set in an empirical exercise. And second, we looked very closely, like Ayhan said, at 13 case studies of accelerations in 10 countries. And out of these 2 exercises, I want to present to you 3 policy conclusions. And the first one is initial conditions matter. Accelerations are more likely to occur when global growth is high or countries have well-functioning institutions. So for example, on the left, I'm showing you if global GDP growth increases from the 25th percentile in our sample, which is about 2.1% of growth, to the 75th percentile in our sample, which is about 3.5% of growth, the probability of starting an acceleration increases by about 5 percentage points. Similarly, the probability is much higher when institutional quality is higher. But second, policy packages, reforms that consolidate government finances, increase cross-border financial flows, and lower trade restrictions increase the probability of starting an acceleration. So in the right panel, I'm showing you the impact of a 1 standard deviation change in these policies in our 3 policy indicators on the probability of sparking an acceleration. So just to give you an example, the blue bar shows you that when countries improve their primary balance by 2.3 percentage points, the probability of starting acceleration increases by 4 percentage points. But I want to make one really important point here. What we also see over and over again is that comprehensive reform packages matter. If you do all of these reforms in a combined package, the impact on the probability of starting acceleration is actually higher than just the sum of the individual impacts of these policies. And third, these policies are much more effective when institutions are functioning. So the answer to that question really is comprehensive reform packages matter. Are these reforms easy? Do they require Herculean effort? Yes. But let me end on an optimistic note today, because what we also saw in the study is that these episodes, these reform efforts have happened before about 200 times. And so when we look at this decade, the 2020s, growth is not shaping up to be the way we imagined it. There's a slowdown in potential growth and investment growth. There are many challenges. But what we show in the chapter is if countries do what they have done before, implement comprehensive reform packages and spark these accelerations again, then we can turn the tide on the slowdown in growth by the end of this decade, and with that have a chance to overcome the development and climate challenges. So I hope to have this conversation with you here today, but please also follow us on LinkedIn because our team works on many other issues, not just investment, productivity, inflation, debt, commodity issues that policymakers and EMDEs are facing. And with that, thank you very much for the invitation, Adam. Back to you.
Good afternoon, everyone, and thanks to Ayhan and Kirsten for presenting this. Thanks, Adam, for inviting me here. I enjoyed reading it, the chapter very much. It's typically IHAN, careful, data-intensive, illuminating, and very thoughtful. So congratulations to you and your team for having done this a very nice piece of work. My remarks are going to be in three parts. One, I'm going to nitpick at a technical level. I have to do that, but I think it's important. Second, I'm going to kind of say why I'm not, why one shouldn't be too surprised at what they've done. So I'm going to kind of little bit push back. But it's the most important is the third part where I'm going to argue that actually, maybe unbeknownst to the authors and to the chapter, they actually do shed a lot of light on three huge development debates going back 70 years, which I think they should do more to bring out of. So without further ado, let me begin. I'm going to nitpick mostly on the data side. As I understand it, a lot of the investment stuff comes from the Penn World tables. Warning, any time series work with Penn World table is problematic. This is my favorite example because I know this well. 1980 to 1990 was the period when Indian growth took off. You see that in Madison, you see that in the World Development Indicators, you see exactly the opposite in Penn World Table. So I don't know how general this is, but if you remember, Adam, on Friday, we had a very distinguished professor from UPenn who said, time series, he stays clear of Penn World tables. And remember, this is the GDP data. How they construct the capital stock investment is kind of... So at least I think, Ayhan, if you could show that your results go through with alternative data sets like the IMF, that would be very reassuring. Second, your investment accelerations, it's very technical, very sophisticated. But the question is, does it pass, basic smell tests of what we think of as investment acceleration, right? Again, the two countries I know I'm least ignorant about, China and India. I think that, for China, you have two, if I'm not mistaken, and for India, you have three. I've highlighted the years. But it seems like, you're missing some big ones here, and of course, the post-global financial crisis. So, I mean, maybe technically they don't pass your whatever sophisticated thing, but I do think that there are some smell tests which I think for India you do better. Maybe you miss something here. India you do better, but it's something that I would urge you to just go back and see whether it passed the smell test for accelerations. There's a third chart which I may or may not want to show you. It's a problem with all cross-country work, but in India, this is something that I would really urge you to be very careful about India. So the black bars are growth rates of investment, consumption, credit, imports, exports, taxes, assets, earnings, all annual real percentage growth. And you see what happens between the pre-global financial crisis where there was a genuine boom and thereafter, everything collapsed by about 10 percentage points a year, and India's GDP remained unchanged, measured GDP growth remained unchanged. So when you deal with cross-country data, at least be a little bit careful about some of the big ones. Okay, so that's nitpicking aside. I'm going to maybe come back to this later. Second, 2 points here. Why should we be surprised that investment accelerations produce all this good stuff? I increases K, K increases Y, and if I is surging, K will surge, Y will surge, poverty will come down, everything will come down, So unless something weird is going on with the efficiency of investment, which we'll come to at the end with a notable exception, we should not be surprised. Investment accelerations will produce magic. That's not so. I can't think of an episode of history where you had rapid growth, etc., without investment going up, and so I'm not surprised by that at all, and I don't think we should be. The second is, I think, what Adam also referred to, that I don't want to be dismissive. There's a lot of very good work here, but I do think that in terms of what can create the policy causes of these things, this adds no more or no less than what we know from the growth acceleration literature, the growth literature, whatever. All those literatures actually offer a very limited amount about, we know you have to do all the good things, you have to open up, you have to do financial sector reform, you have to have stable macro, good institutions. The litany of things you have to do is long, well known, but completely elusive in terms of, how countries can actually achieve this. So both not to be surprised by the good things that investment accelerations cause, but also I don't think, and this is not a fault of the authors. This is the big question in development economics. Why are some countries rich and others poor? And getting investment going gets to the heart of that question. So it's not a fault of the paper, but it's not something that is easy to get a handle on. Now I want to come to the third point where I do think they make a contribution. And I think this actually speaks to three, I would say, very big debates in development. I will call them the Krugman-Alvin-Young debate, the Lewis model debate, and the DeLong-Summers debate. And let me tell you what I mean by each of these. Paul Krugman has a very famous piece in Foreign Affairs called The Myth of Asia's Miracle, and it was all about, is it perspiration, is it inspiration, is it deferred gratification, savings and investment, or is it total factor productive growth? And the truth was, who cared? At the end, we know that, if you can get growth up, that's all that matters. And what this paper actually shows nicely is that all these damn good things are correlated in the first place. So, to nitpick out whether, I went up or TFP went up, was a completely, I think, a kind of a dog's breakfast of a debate. And I think this does speak to that debate and says, guys, don't nitpick, don't get too cute about these things. They all get correlated. And we know the policies that are going to cause investment to rise are also the policies that are going to get efficiency, TFP growth, et cetera, et cetera. So, don't get into the weeds too much. And I do think your results speak to that, which I think you should highlight a bit more. I think the second big debate, I would call this the Arthur Lewis debate, and I think where development economics just went down the wrong path was this, development and growth and savings constraint. And therefore, all the thing about how do you get savings up. You set up the World Bank and EBRD and IBRD because you think countries don't have enough savings. Therefore, they need these external dollops of help from every donor and his uncle, and now every philanthropist and his uncle. And that model turns out to be completely wrong. And this actually speaks to that in the following sense, in a slightly indirect way. If investment goes up and you get an investment surge, right? If actually savings don't go up commensurately, you're going to have external difficulties. Some form of, I goes up, S doesn't go up as much, so your current account and your external situation is going to be vulnerable. So the fact that that doesn't happen, that when I goes up, S also goes up, tells you something that, the binding constraint to growth, I'm not saying this is definitive, but the old binding constraint on growth is savings is kind of undermined, because this says that if you can get investment up, you're going to get all the good things, savings is going to go up, you're not going to have financial crises, etc. So I do think this I need, at the margin kind of undermines the whole savings as a constraint to growth, and I think that's something that you should highlight more. Now, on the DeLong-Summers debate, DeLong and Summers had a famous piece 30 years ago saying it's plant and it's not any old investment that's important, but investment in plant and machinery. Now, it's an interesting idea, but I think that the way one should think about this, and where I think you didn't do enough in this paper, is to think of investment as having, I think, three components, right? One is plant and machinery, one is kind of construction/real estate, and the third is public goods like infrastructure. I think it's a mild form of intellectual imperialism that we think that public investment is public infrastructure, when that's not the case. It's decidedly not the case. And so one of the things I was surprised by, Ayhan and Kirsten, is that you didn't have enough investment accelerations in the 50s and 60s, when in fact around the developing world, public investment was rising very rapidly. But, and I know this from the Indian experience and a bit from the Chinese experience, this public investment increase was actually state capitalism. It was exactly plant and machinery, DeLong and Summers, but which didn't give you all the good things. So when you decompose investment into public and private, I think, it may be interesting, I think it's important. But I think as important is going to be, was this plant and machinery, or was it public goods like infrastructure? Because I do think that a public infrastructure investment, or even private or infrastructure investment more broadly, can get you very different results. And you didn't quite unpack that. And that will also speak to some of the historical stuff, because historically it was a DeLong-Summers experience. Plant and machinery went up, but it's all in the public sector, highly inefficient, and therefore, so I think you could speak more to the DeLong-Summers thing. And the one kind of sub-variant of that, which you don't go into, is that what if the investment booms are real estate booms? And do you get instability associated with that? So that's why the unpacking into plant and machinery, real estate construction, etc. And it also becomes important in the context of which is my last point I would make, is that can you also have too much of a good thing? And of course, China is the preeminent example of that. So maybe there are cases, albeit rare, when too much investment is, and this is Adam has written about this, others have written about this. So I think that that's also worth kind of thinking about. So thanks very much, and enjoyed reading the paper very much.
Thank you, Arvind, Kirsten, and Ayhan. That was fantastic. I'm grateful to Ayhan, Kirsten, and their co-authors for giving us so much material to think about in the public debate as well as at this event. And I'm grateful to Arvind for doing his inimitable, in the literal sense of almost no one can do what he does, of pulling out from the smell test to the biggest picture of what are the great questions of development. So thank you all. Let me just pick up one last thing on what Arvind was saying. I do think as you go forward amidst your 20 other publications, as Kirsten rightly marketed, some of these breakdowns that Arvind was talking about, particularly the real estate versus other forms, I think is critical. And I must admit, reading the very rich chapter in the Global Economic Prospects volume, since you have 200 cases, which for microeconomists is not huge, but for macroeconomists is enormous, some subdivision into, even which ones fell into financial crisis later and which ones didn't. Just a little bit more of that, I think, would be very helpful. But it's a great topic, and it is a source for hope. Now, first off, just Kirsten and Ihan, if there's some way that Arvind or I overlooked some work you've done that either not in this report or in other work you've done that addresses some of his issues, we would welcome that. But more generally, any response to the comments. And could you press the button at the bottom of the chart?
Oh, yeah. Thank you, Adam, and thank you, Arvind. That was fantastic. I agree with you, whatever you said. For those of you who do not know, actually, Arvind has a very nice paper with Simon Johnson and Chris Papageorgiou on the issues with Penn World Tables and different vintages, and published in the JME, no? Yes. And I have an anecdote I need to mention, Adam, here. Simon, when he was the chief economist of the IMF, I remember we were in his office, we were discussing a research project, and we were discussing some issues, and then he asked, what data you use? And I said, maybe we will use Penn World Tables. And he immediately said, oh, we need to check that. So and that was a surprise for me, hearing the chief economist questioning the data source. But there are issues with the data, and in the context of investment data, these problems actually magnify, because in some cases, investment is residual, actually. But we can look at other sources. We spent quite a bit of time in terms of putting together the data set. And the cross-country data in the context of investment brings more challenges. So there is no question about these things. With respect to the methodology and what passes the smell test, what doesn't pass the smell test, Kirsten will respond to that, what we did. I think one issue there, I was thinking Arvind would raise, ultimately what we do, we have just one threshold for every country, Arvind. In fact, and there is a reason for that, because you need to keep something constant. You might say, for India, the threshold is 5%. For Bangladesh, maybe 3%. For Thailand, is 4%. But we kept it same just to bring this, kind of all of these, in a sense, observations together and the reference point same. But now at the country level, when we do this exercise, we want to do it with country-specific thresholds. By the way, the India results you show are fascinating. I would thought actually the opposite. The GDP growth reflects the other things. So I need to think about what is going on with the data set in the context of India. Now, the second issue, there is no surprise. There is no surprise, but the results are, to me, quite striking. There are two things. I think it's not surprising investment is associated with these growth outcomes. What is surprising, how significant the outcomes are and how broad-based they are in these economies. I think that is a surprise. Arvind, you said that certain things are elusive. I think what this chapter says, yes, ex ante we might think that they are elusive, but ex post, after we did the exercise, there are almost 200 episodes. Maybe they are not that elusive. Countries did deliver these things, and the case studies we presented, they basically talk about these specific policies. And you might say these policies are the standard policies. I heard all types of people calling these policies with certain names. The bottom line is that countries delivered, and they can deliver again. Maybe they need to do different types of reforms. But the fact that we have this many episodes, to me, one, encouraging. Two, I wouldn't call that elusive. It's just it is there. Third point you made, now we need to write a paper, maybe we need to write it together, how to resolve these three debates. And there really, all of your points are right on target. Last week we were actually in Europe. Somebody brought this idea that this is not surprising, it's the Rostov theory of economic growth. Maybe that's, also there. I like the idea of thinking about decomposing investment, Adam, looking at these real estate booms versus others. There is one issue, okay, and I see this all the time, I read it all the time, and I think Adam, Arvin, you, I think, are exposed to it as well. There are a lot of slogans in the context of investment, a lot, in the policy domain. We need to accelerate investment, we need to mobilize private capital, etc. Yet alone, we don't have actually good data to look at these things. We don't have good comparable data for private investment and public investment. That's why, it is difficult to undertake the types of work we think very useful at the sectoral level, and so. Now, the one important issue, I think, in a sense, Adam touched, and I was thinking when that question was going to come up. What happens at the end of these episodes? How these episodes end? In the methodology we use, we just look at the average growth of investment, whether it goes down below 6 or it contracts. But the first instinct of an economist looking at this study and the methodology would be, oh, these economies are overheating. They're going to hit a wall eventually, or most of them will hit a wall. They would have all types of problems. But Kirsten already showed you. In fact, things improve on average during these accelerations. And 80% of accelerations did not end with crisis. 80% of them. Now, there were some accelerations that did end with crisis. Korean episode, some countries, Asian countries had accelerations during the 1990s. Those accelerations actually ended with the Asian financial crisis. That's for sure. And that brings the kind of the issue of not just comprehensiveness of policies, but in a sense, thinking through whether these policies address the vulnerabilities. But let me stop there. Kirsten, you want to discuss other issues? Yeah.
Yeah, thanks, and thanks for the comments. I just wanted to get back to the SMED test that you said, because in the short presentation we didn't present all the many different robustness exercises and we did in the study, but there's a long and very nice appendix that we spend a lot of time on that explains all the different things that we did. For example, comparing pinvoted table to secondary data sources. So that's why our data set doesn't include all the 190 countries in pinvoted table, but the 104 for which we have secondary data sources, and they still represent like 96, 97% of our GDP. So the sample is something we thought is more reliable. One of the charts you showed, what's going on with China and after the acceleration. Well, the acceleration is actually still ongoing. It's the longest acceleration we have in the sample. It started in 91 and it's still ongoing. So if you look at the China chart, we have these sometimes longer episodes. We, of course, didn't just look at, 6 years, that threshold. We looked at 6, 7, 5, 8 years of minimum durations, different thresholds. But one of the important criteria is, and we didn't mention this in the details today, that investment is very volatile. Sometimes you have like 20% in one year, minus 2% the next year, then 10%, then minus 4%, and on average, maybe you have an acceleration, but what you really have is just, crazy investment growth. And so one of the criteria is like during the acceleration, there can only be 1 year with a contraction, and that's it. And so we see in many EMDEs where average growth looks nice. If you look in, zoom in and look at the episode, it's actually not so nice. So I just wanted, that what we're presenting is what we came up with as the most robust set of episodes. And looking at the case studies, we looked at a couple more than 13. These are the ones we really worked out. We do think we found the ones that are really the credible episodes.
Arvind, anything you want to say? Before I turn it over to our audience, and when I do, please wait to be recognized. You can go to the standing mic in the middle. There's also a moving mic, I believe. Yep. Please identify yourself both by name and affiliation when you speak. But one question, just to be a little provocative. So in your report, in the chapter on the magic of accelerations, and I take very seriously, I'm not saying they don't use the word magic lightly. One of the old magic tricks seems to come back. So in figure 3.10, panel B, you're doing a set of probabilities that acceleration will start. And one of the largest moves in increasing probability is to go on exchange rate undervaluation from the 25th percentile to the 75th percentile. Institutional quality, GDP, global GDP growth, per capita GDP don't seem to have as big a swing. And if you go back into one of the many deep, rigorous tables that Kirsten was mentioning on table A3.2.2, you've got a lagged undervaluation index, which, depending how you look at it, is certainly as significant and possibly as large as any other factor. So again, this has long been held as one of the great magic tricks, that if you can sustain an undervalued exchange rate for a while, you'll do very well. We long ago published Surjit Bala's book on this. My predecessor, Fred Bergston, viewed this as a dirty trick, not a magic trick. Maybe you could say a few words about how you see that particular factor playing out, and maybe Arvind can contextualize that in the broader, where we stand now on that issue in the broader development debate.
So I'm sure Arvind has views on these things. He has written quite a bit. Now, indeed, if you are able to keep the exchange rate undervalued, and you are an open economy, you have quite a bit of exports, you can trigger an investment acceleration. The key word is sustaining, because we know that these types of attempts often lead to, one way or another, certain imbalances in these economies. I remember the writings. Arvind, you contribute this literature quite a bit with Danny. This idea that China did it, why other countries cannot do it. Of course, ultimately it boils down to whether you can do it for an extended period of time. The issue at the end of the day, when we focus on the policy messages, we want to focus on what we think core, meaningful tricks, for the lack of a better word, not the dirty tricks. I don't think Arvind called that dirty, but yeah. Oh, no. So the issue is that there is another result I want to mention, Adam, which will resonate with you. Adoption of inflation target makes a big difference. Sorry?
Adoption of inflation target. Actually, I read it as it made less difference than fiscal consolidation.
So the having an independent central bank, strong commitment to price stability, is an important driver. So we basically call it, monetary policy reform. All of these things are important, but that result is there. Is it surprising? To me, it's not, but yeah.
Yeah, that's a important question, Adam. I think that I think there are three dimensions to this, right? One is undervaluation to kind of kickstart an investment acceleration, and I think there are episodes around which Danny and I have written about where Chile, for example, in the 80s. Where this was, and in a couple of sub-Saharan African countries as well, where you can kickstart investment and growth acceleration to this. But as you quite rightly said, the other, I think, situation is, which I think, and this is controversial, and I think maybe it's not so much kickstarting, but sustaining an export boom by not allowing the exchange rate to appreciate. That's China early 2000s. That's a kind of a different story from actually trying to depreciate your exchange rate through some means and getting the investment and growth kick. The China story is a different story, which is you maintain it. And of course, the third thing in all this, which others know better than I do, is that your ability to sustain this is going to depend upon the capital, how open a capital account you have, and so I think Danny and I have always had the view that this is something that many developing countries kind of succumb to the siren call of financial globalization too early, prematurely, without having necessarily a regulatory system that could handle capital flows. And one perhaps collateral cost of that was also to not have this tool, which of course you cannot use indiscriminately or sustainably, but on a one-off basis you can.
Terrific. Thank you both for engaging with that. Let me now turn to our audience. If anyone would like to raise their hand. In back, could you come up to the standing mic, please, if you're able. Thank you.
Thank you very much. Cullen Hendricks here with the Institute. So you talked about the fact that thankfully very few of these episodes end in some sort of economic crisis, but I'm wondering about whether or not there's a role of crisis in creating the sort of the conditions necessary for the massive kind of policy reforms that you are talking about. I mean, is it the case that these are often preceded by growth collapses, financial crises, civil wars potentially in developing countries? Thank you.
I should note, for those of you who don't yet know him, Cullen is a senior fellow here who works on political economy, particularly over conflicts and resource issues. And so he understandably focuses on the underlying causes of these things. Anyway, any views on that from the panel?
Yeah, thank you. That's a very important question. These comprehensive reforms are difficult. That's why we talk about them in these details. And it needs a catalyst to start reforms. And we do find that in many cases, there has been some kind of national event that provides this catalyst. So in the case studies, for example, we see that Korea coming out of the Asian financial crisis, or Turkey in the early 2000s, they were in economic situations where the government basically came together and said, okay, we need to do a certain set of reforms, reform the banking sector, improve regulation, consolidate finances, improve the business climate, improve the legal framework to attract also private investment. So yes, we do see that in many cases there is a catalyst.
Great. Yeah, Arvind.
No, it's not a response to the question, so I'll do it later. So
okay, thank you. At the mic, please. Yes.
Oh, hi, I'm Steve Kamen from the American Enterprise Institute. I had a question about the wave of Chinese financed and managed infrastructure projects around many EMDEs in the decade before the pandemic. Are any of the investment accelerations in your sample actually associated with that activity? And what do you think about situations where, without doing a lot of the basic economic reforms, you do have a very large, infrastructure projects, basically government financed or externally financed?
Thank you.
We did not check that, Steve. Maybe we should check it, because in some cases, obviously, when you have this type of investment coming, and it doesn't have to be China. Huh? Sometimes you have resource discoveries, and that brings significant investment to a country for an extended period of time. But we did not actually try to identify those episodes, but we can do it.
One part response and a follow-up question, follow-up thought. I think that if you looked at their numbers, in the post-global financial crisis, the share of EMDs with investment accelerations declined very sharply, right? And that's the period when BRI took off. So this is just a correlation, but I would be very surprised if the BRI stuff accounted for many of these accelerations. My follow-up thought, Ayhan, is that if I had written this chapter, I would have actually motivated it in the following China kind of contextualized way. I would have framed it as, look, investment has been very weak in the post-global financial crisis, but now there's a big C+1 opportunity around the world, with capital fleeing China. What should countries do to attract this as a way of increasing their investment? So I might have, sexified it in that way in terms of writing this if I had done that.
Which may be why Arvind is at the Peterson Institute and not at the bank or the fund. But anyway, unless Kirsten or Ayhan has an important additional point, I think we'll wrap it up there. Of course, they have many important additional points I just meant to get out at this moment. I recommend to everyone following global economic prospects, and in particular, reading the latest report's thematic chapter on, or analytical chapter on the magic of investment accelerations. I thank Ayhan and Kirsten for joining us today, and I thank my colleague Arvind for, as always, lifting and contextualizing the conversation on these issues. Thank you all very much.